Hey everyone, Tom here, Park Avenue Forex, introducing a sister to Park Avenue Forex, which is going to be the trading room called Brains, Money, Guts. And just here to do a really quick part one of a two-part video series. I find that if I talk too long, people lose interest and don't finish. And I think that this little PowerPoint presentation is going to be really cool. It's going to really introduce you to some really cool aspects of trading. It's going to bake your bagels. You know, if you just sit through this, it's probably going to be about, I don't know, 6 minutes long. And then I'll put part two in for you guys. So introducing Brains, Money, Guts, the new sister to Park Avenue Forex, the trading room sister. Okay, so I'm going to first talk about, just rule one of the trading room. What I suggest everyone do is keep a trading diary or a log. So basically what you're going to do is you're going to do your daily analysis and you're going to put down on a sheet of paper your thoughts for the trading session. Or you can put it, a lot of people like to use electronics. I'm not that savvy, so I end up writing on a notepad what my analysis is telling me, where markets have stopped, where was resistance, where was support. Basically, it's going to be a hypothesis on what you believe the overall trend for that day is going to be. You have to take in consideration what the major trend is. Now, if you're trading, 4-hour charts, you're going to look at the dailies. If you're looking at dailies, you're going to look at the weeklies. The weekly charts will tell you basically that it's going to be a bigger like market trench, which would be like a fence around the marketplace, but it's going to be there. And you need to kind of like look at that trend. Now, that's not to say that the trend can't reverse. And that's what we're really looking for as contrarian traders. We're looking for the point at which the trend actually turns. That's where the big money is. It's where the big money is. But what you're doing on this in this little exercise is you're basically saying, okay, here's my daily. I'm looking at 4-hour charts. I'm going to use my daily chart as a way to determine like where resistance and support is. I'm going to watch the marketplace at those points. So that's where you're going to, where do you believe the market will find support or resistance? And what I want you to do is if you're trading the points, wonderful. You're going to write down, took trade at support, put a stop loss level here, trade went into my favor by X, exited, blah, blah. You're going to write everything down that happened. You're going to keep a log of the market reactions at your predetermined points. So if you think there's going to be resistance at some level and the marketplace just blows right through that, you got to write that down in your trading log. Like had resistance up at 80, market traded to, a big figure higher with, at 100 points higher, 150 points higher. So something has changed, the market shifted. So, this is where you're basically going to have to learn, the proper aspects of trading, which are basically the tasks of trading, which is the first step is really to stalk your prey. Like you have a point that you're interested in. You have to actually, laser focus on what's happening at that moment, with the marketplace. So the brains behind money management. We're moving on from the log to, what should we be doing, with money management? Money management is probably one of the most, one of the disciplines that's really most neglected because everybody's interested in entry. They're interested in making money or, they really don't focus on like money management. Money management is so important because even if you have a slight edge, really good money management can take that slight edge to incredible heights. But so the first step is you have to define your risk. Know before a trade is executed how much you're willing to risk on any single trade. If the reward that you see is not at least 2 times the risk, don't take the trade because most likely you're not going to get 2 times, but you may get 1.25, maybe 80% of it. At least you have something that you can ratchet your stop loss down to entry so that if the market turns, you don't lose anything. Okay. So you need at least 2 times risk to take the trade. Place a stop loss as soon as the trade is executed simultaneously. Don't wait. Don't give me the stuff. I'm going to use a mental stop and then, I'm going to put the stop in. No. Cue it up. As soon as you take the trade, stop loss is in. Use it 2 times the ATR stop or a variation of it. So you're going to be using average true range for your stop. 2 times is optimal. You could use a variation of it, 1.3 one and a third, 1.5 ATR. Don't use a money stop. Money stops are kind of, that's not taking into any consideration the volatility of the marketplace. So ATR is a better stop. If the position size must be adjusted down to the ATR envelope, then do it. So in other words, if your average true range is, 100 pips, you need a 200 pip stop because you're going 2 times the ATR, and then you can't hold whatever you normally hold. You have to cut it down to that one. If the trade is wrong, you get out with the same loss. So you have to basically adjust your position size. The overall objective is to not become an involuntary investor by holding on to a losing position. So if your stop is not in, basically what you do is negotiate with yourself when the trade is going against you, and it's beyond what your mental stop was. You start saying, well, I'm just going to give it another 30 pips or so. And then it goes beyond that. You go, well, another 12 pips. And then, and before you know it, you're losing a lot more than you want, which basically, plays havoc with your trading psyche. You need to be able to trust yourself. So place your stop, stick to your stop, place your stop immediately. We're going to be trading several edges, and they're going to be discussed in the trading room. But we must fully understand the edge that we're trading at that time and the edges that we are using to exploit the marketplace. We have to realize that no matter how good that edge is or they are, it is not infallible. You have to, accept the fact that the market is always right. Now, I would suggest you guys write this down and place it on a keyboard, place it on the wall in front of you in plain sight, and in bold letters, or put it in your iPad or whatever you use and type it in there and then print it. Markets are never wrong. Opinions often are. Markets can stay irrational much longer than you can stay solvent. Very important. Markets are never wrong. You could sit there all day, start cursing at, dollar yen for not doing what you wanted to do. Doesn't make a difference. The market's not wrong. There are millions of brain cells out there working at that time, and you're only one brain cell at your little terminal, in your little office someplace, in the world. So the market's not wrong. You're wrong for that time. Now it could turn around and you could be right, but the thing is to step aside and wait. If you do that, you'll free your thinking, and you'll take a much better trade in the near future. Could be a couple of days, could be an hour, could be 5 minutes, but just clear your thinking, step aside. 3, have a time stop. Paul Tudor Jones introduced me to this idea, and I thought it was kind of really like a paradigm shift. He basically said that if he takes a position and if it doesn't react the way he expects it to react in a certain amount of time, he just closes it, just gets out. It's not worth it. He looks for something else. So he wants to get involved in a trade that's going to be, quick moving in his favor. And I agree with that. I mean, it's great to be able to pick a bottom or pick a point of support, enter it, and the marketplace rallies. Okay. So we're going to be getting into that in a second. Like, what is, the time factor? And it's going to be on the next slide. So why do we want to do this? Why do we need a time element to this whole thing? A time stop against a non-performing trade, if you have a non-performing trade, your focus of attention is going to be on the outcome of the trade. You're not going to be able to think clearly. You're going to be constantly looking at the price, wondering when it's going to do what you expect it to do. It's going to approach it, then run away from it, and go back against you, thinking, oh my goodness, it's going to break out and go down and stop me. It's really, truly a waste of mental energy. I used to tell my traders on the trading desk when I started implementing this that, a non-performing trade is like mental masturbation. It's not any fun. When a trader is focused on an outcome, the trader has become more rigid in thinking, which will then create an idea of speed over accuracy mindset. So in other words, you're focused, you're constantly trying to force the marketplace to speedily do what you want it to do. That makes you rigid. That makes you completely unable to really look objectively at things. Non-performing trades can also cause a condition of anxiety, doubt, and frustration, which in turn produces non-adaptive behavior. It's the same exact thing with, speed over accuracy. It's a non-adaptive behavior. The trade takes up too much processing capacity of the human brain. Just too much. If you think about it, all the times that you were, sitting there waiting for something to happen, you're wasting a lot of mental energy. You're exhausting yourself, giving yourself a headache, making yourself doubt yourself. It's best just to get out of it. It's just not worth it. So how much time is too much time? Well, I suggest using the square root of price of the financial instrument to determine the time factor to exit the trade if there's no positive development. So what exactly do I mean by that? I mean that if you have a price of, 106 in dollar yen, what you do is you take the square root of that price, which I believe is like 10.29 or something like that. I don't have my square root calculator, but I'm trying to remember from memory. It's like 10.29. And that's basically your time factor. So it's about 10 hours or 10 bars from whatever you're using. So if you're using a 4-hour chart, it would be 10 bars forward. So that's 40 hours. You're giving the marketplace 40 hours to do something. If you're using a 1-hour chart, you're giving it 10 hours to complete a cycle. If you're using it daily, you're giving it 10 days to complete the cycle. Now, generally, I have found that a good potentially moving market should move approximately 60 to one big figure and the amount of the square root of price or less. So let's say, for instance, you're using a 4-hour chart and you got 40 hours, within maybe within 8 hours, 2 bars, the marketplace is up 100, 150 pips. That's good. That means that time is definitely in your favor. Things like you've caught a point in time when there's a lot of demand if you bought, or you caught a point in time where there's a lot of selling and you're short. That's fine. Now you just need to monitor that trade, okay, to make sure that it keeps progressing in your favor. So this is part 1 of a 2-part series. And just wanted to give you that. I want to introduce you to Brains, Money, Guts trading room. And I look forward to seeing you guys actually inside the trading room where we can talk and have a real good time. And remember, enjoy the party, but dance near the door. Cheers.